Bloomberg Audio Studios. Podcasts, radio, news.
This is the Bloomberg Daybreak Asia podcast. I'm Doug Krisner. You can join Brian Curtis and myself for the stories making news and moving markets in the APAC region. You can subscribe to the show anywhere you get your podcast and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app.
Joining us now on the program is Ed Ludlow, Bloomberg Technology co-host, to talk not only about Tesla's Robotaxi launch, but also AMD's results and developments and his impressions sitting down with Lisa Su, the CEO at AMD. So let me start off first, Ed, with Tesla. It's a little bit sexy because it's Elon Musk and it's Tesla. So how critical is this moment for both?
Goodness. Good morning, gentlemen. It's a really difficult one because on the one hand, it is a story that Elon Musk has been telling and promising for a decade. And on the other, anticipation and tension in the stock from investors is so high. It's critical to a lot of investors that they see evidence. Tesla's future is not as a business of selling electric vehicles direct to a consumer, but it's a business where they operate this really big fleet of cars that drive themselves. And the business model is like Uber or Airbnb even, which we can get into, but it's a proprietary ride-hailing app. And that might be really confusing. I can really sympathize with some of your listeners around the world right now saying, hold on, are we talking about Tesla here or something else?
So I can understand the vision. The question is, how expensive an endeavor is this?
Yeah, well, there's two paths toward it, right? So the basics of what we will see this evening, my time, are the Cybercab, a purpose-built robotaxi, a vehicle that, according to my sources, has two seats, kind of funky doors that we call butterfly wings. They're like, those very expensive hypercars that open upwards and out, probably no steering wheel. And so that's part one. They'll build those, and then they have to get regulatory approval for them to work in the jurisdictions that they want to put them in. The other path's the kind of Airbnb bit. So think about how Airbnb works. You have a property, a house or an apartment. When you're not using it, other people can use it and you make money. What if you applied that to your existing Tesla? And that's, I think, how Elon Musk sees the gap being bridged. As you guys know, Tesla has a current software, full self-driving, that can kind of drive itself in consumer cars. And the option that he wants to give owners of Tesla vehicles is, if you're not using it, put it on our platform and let it leave your house and drive itself to a rider, wherever they may be, pick them up and take them wherever they want to go.
Yeah, as we move to monetizing everything in life. Gaffes, Ed, have been a problem for Tesla on some of the earlier product reveals. It would seem to be even more important here to hopefully avoid that, given that we're talking about something that ultimately will not have a human element.
Yeah, so let's say, for example, they do unveil a purpose-built robotaxi, and there are a few thousand people on the Warner Brothers movie lot just down the road from where I am now, and they get in the vehicle. Well, point number one, why are they doing it at Warner Brothers? Warner Brothers is private property, so they don't need permits or regulatory approval because it's private property, not public roads. But you'd think, guys, by this stage that they wouldn't let people demo the tech if it didn't work. And as you guys know, my sourcing in the company, the people that I speak to, I think they're very excited about this. They think that they've got something that they'll show that will move Tesla forward tonight. But it's right to have skepticism because Elon Musk has been telling us that next year will be the year for a decade, and we're yet to see it.
So it's either that or the reason that they're Warner is because it's the land of fantasy. Let's hope that that's not the case.
Good one. Yeah.
Can we pivot to AMD? What did you learn today in your conversation with Lisa Su?
Gosh, the Wall Street fever around AI and chips is still kind of super intense. AMD, the market accepts, is a really good number two player behind NVIDIA, where we also accept NVIDIA just is dominating the market for very high performance GPUs that go in data centers. Simple as that. So what AMD brought out was their latest one. It has some outperformance relative to the H100, and you may have discussed the H100 on your show before. That is NVIDIA's old one. So it's kind of like inch by inch, they're racing each other. NVIDIA is well past the H100. It has 2 new generations past it, and AMD's trying to catch up, and investors are setting the bar really high. And I think that the reason the stock closed down 4% is that Lisa Su probably didn't say enough about right now which customers are paying her money for her latest stuff.
Yeah. Yeah, I mean, we talked about the gap between the two, that NVIDIA's business is like 25 times what AMD has in these types of accelerator chips. But she also did talk about the overall market for such chips. And so this brings in really investors to, the whole space. I think she talked about how before she talked about $400 billion in 2027, now $500 billion, $500 billion in 2028.
Yes. Yeah, so for context, she is talking about the market specifically for AI accelerators, chips that are used to either train large language models or foundation models, or for what we call inference, which is the use of the model to make a decision, right? And $500 billion by 2028 is a big number. And for context, the entirety of the semiconductor industry in calendar 23 in terms of sales was about 550 billion. So you can see the direction that we're headed. But again, 2028, like, come on, that's 4 years from now. Tell me how you're booking revenue 4 months from now, and I might, be a bit more excited about the trajectory of the stock.
So we know that NVIDIA uses TSMC to produce its chips.
Correct.
What does AMD do on the production side?
Surprise, surprise, they also use TSMC.
Oh, really? They don't make their own?
No. So, again, this is the really crucial thing about covering the semiconductor industry. We call them chip makers. They are not. They are chip designers, essentially. And TSMC is the chip maker. Samsung is a chip maker. And in this country, Intel, and to a smaller extent, global foundries. And I asked Lisa Su, it was a bit of a loaded question, but it came from one of our audience members, which is, have you talked to Intel about using some of their foundry business in the United States? She didn't really answer, but what she is looking at least, is her options in the US, because that's also the direction of travel, right?
Outside of the AI accelerators, in terms of really looking at the broader market, Lisa Su has cut into Intel's business a lot for data centers, right? For those types of chips.
Yeah. Data centers require all kinds of chips, principally CPUs. For every GPU you have many more CPUs, and they have a product for that, a new generation they announced today. I would also remind you guys, AMD does other stuff. They have great PC chips and gaming chips, and they have really overtaken Intel, and they had a lot to shout about on that front too, but it's not a needle mover for the stock.
Yeah, I think she told you that they have 34% of the market for servers at the moment. Anyway, out of time now. Ed, thank you so much. Ed Ludlow, Bloomberg News. Joining us in our studios in Singapore is Mary Nicola, Bloomberg M-LIV strategist. So, Mary, the economic data that we got, the jobless claims, and the slightly hotter than expected inflation data, noise or signal?
I still think it's noise, because a lot of what we've seen underlying that the employment rate is doing is pretty strong. The labor market is still pretty robust. And then if we look at the consumer, which is absolutely critical for the U.S. economy, they're still doing really well as well. So it's still, and every data point, we can't be overly reactive. We still have to take a step back and look at the bigger picture, and the bigger picture is still strong. Yeah,
speaking of the consumer, we're going to get data from the University of Michigan tomorrow. I mean, do you think that there is a risk here that we see a hot reading, that the consumers are feeling pretty positive about the American economy?
I don't know. I find the University of Michigan one a little bit skeptical because it's very dependent on oil prices. So tell me where oil prices are and I'll tell you where the University of Michigan goes. So I don't think it's as indicative as, let's say, retail sales. I think retail sales is a much better indicator of where the consumer is heading. So if we're looking at those readings, we're in a much stronger position for the U.S. consumer.
So let's take a look at China, because you do have this Ministry of Finance briefing tomorrow morning. You know, it kind of feels like this is getting towards a make or break kind of moment, at least in terms of investor attitudes. Investors were pretty shaky this week on whether or not they believe that China really wants to see this thing through, Mary. So what are you expecting tomorrow? Are you expecting good news for markets or more disappointment?
You know, I think you put it well, Brian, in saying that it's a make or break moment, because we were very excited. The market was very excited about what was coming through in terms of they were actually going to put a floor on growth. And I still think that there is that incentive and it's still coming there. The key thing, though, is what we're missing is the clarity on the policy details. So we need a clear path, a trajectory of what's coming next and what's happening. And also the main thing, especially what's going to fuel this rally, is what's happening on the consumption side. So we keep seeing reforms on supply side, which is likely to come through, and they're likely to emphasize it. So accelerating some of the infrastructure projects, the fiscal budget, but we really need something on the consumer. And that is going to be the real breaking point of seeing, and the housing market, of seeing China just flourish.
We've seen enormous volatility in the equity trade. What's your sense of how the price action has been behaving and what it tells us about the durability and whether there is a floor in the stock market?
Yeah, it's been absolutely crazy, I think is one way to say it, is that investors have been whipsawed immensely because of the fact that everything has been very dependent on what the sentiment is out there. And of course, we can't forget that most investors out there were very underweight China, and they've long been underweight China. So when you see these crazy moves, obviously there's a lot of short covering coming through. So I think what happens is we're going to see a lot of whipsawing, especially until we get that policy direction and that policy clarity. So unfortunately, the main thing is just expect more volatility.
Bloomberg Economics put it pretty well, saying the PBOC is kind of a good example. They did provide more clarity. They gave you some forward guidance, and now they've been rolling out details. For instance, this equity swap facility. We're getting even more information this morning as funneled through the financial news about the duration, how long the maturity will be, and it'll be 1 year and can be extendable. Anyway, back to the point. Bloomberg Economics says that this is a good example of how to give forward guidance and then deliver. And then we'll see if the Ministry of Finance carries through. And if you look at what the NDRC does, those were sort of like the old style apparatchiks there. Mm-hmm. And what they need now is kind of cutting edge, market educated people.
Yeah, absolutely. But the thing is, it's still, everything's being drip feeded, and that's the problem. So if you just came out if the NDRC had just come out in line with expectations and said, here's the plan, again, similar to what the PBOC has done, which is say, we're going to make, we're going to ensure that policy is ultra loose. We're going to ensure that there's going to be some sort of equity stability facility. So it's a matter of detail and providing those details that gives that comfort to investors that this is just not another false dawn.
So let's talk very briefly about Bank of Korea. As expected, the BOK cutting its benchmark rate 25 basis points. What does this mean really for the South Korean economy?
I think in general, we were looking that it was expected because of the fact that inflation was coming off quite aggressively. We saw that inflation had dipped actually below their 2% target. The key thing, though, is they'll likely take on a more cautious approach just because of the financial stability risks. We can't forget how high household debt is in Korea, and that still weighs on the concerns and the applicability of how they move policy and what direction they're going to move policy in. But obviously, it's what the Fed has done has given leeway for central banks within this region to start cutting rates and the confidence to do so, especially something like the Korean won isn't as under depreciation pressure as, let's say, it was a few months ago.
And what's interesting is that with central banks on the move now and cutting interest rates, you have valuations in the non-U.S. global markets that are way, way lower than the U.S. So can we make the step to say that it looks like non-U.S. equity assets can outperform here in this coming period?
I don't think they can outperform the U.S. because I think really the U.S. still has that exceptionalism. And then if you're going to see earnings coming through and the bar this quarter is very low, so if they just beat just slightly, you still have some fuel to this rally in the U.S. market. But absolutely, you don't see demand destruction in the U.S., which is going to support overall equities, especially within this region. So you do have the growth engine from the U.S. coming through, especially because we're lacking the growth engine from China, right? So there is that push, and then on top of that, you've got global liquidity, and it's coming through, and it's ample, for not only from the U.S. but from the ECB.
Well, I was trying to sell you. Now you're selling me.
It's going to be very interesting to see how earnings factor into all of this. I mean, the big banks kick things off tomorrow. We've got JP Morgan, Wells Fargo. So the banks, if they perform well, and I think the trading volume is going to be something to key in when you're looking at the money center banks. If they perform well and get us on the right foot, that maybe the equity market in the States still has some legs. Is that a fair statement? Very
absolutely.
Quickly.
Yeah, absolutely. We just need equities to continue their stellar performance.
Well, let's get to our guest, Selena Ling, Chief Economist and Head of Global Markets Research and Strategy at OCBC, to take a closer look at markets. Well, we've got a lot of questions for you on China, but I want to start off with the data in the U.S. first, and we can slide into that in a few moments. The data seems to tell slightly different stories there, and given that we had the strikes and we had the storm, in particular, Helene, are you looking at this data as more noise than signal, or something that we really need to be mindful of?
Well, we've always expected that the last mile of this inflation is going to be bumpy. So I think the September core inflation number does kind of like reinforce that kind of story. So the issue here really is that the Fed is still probably fairly convinced that inflation, although it's bumpy in the short term, is still headed lower in the medium term out into 2025. The question is whether they are having second thoughts about, having done that 50 basis points jumbo cut earlier, and what is the way forward. So market expectations of, aggressive rate cuts going forward have kind of been pared back. In fact, if you look at the recent Fed speakers, William, Goolsbee, Barkin, etc., they all suggest that the latest inflation number per se should not interrupt the disinflation process. But the question, of course, is like what Bostic hinted. Would they actually consider skipping a meeting if the data suggests that it is appropriate? So our base case right now, I think, is that probably they will still cut 25 basis points in November and another 25 in December. I don't think this 1 month of data per se is going to change their disinflation story altogether.
Do you have a sense of the terminal rate, where this may end up?
Well, I think if you look at the dots plot, it's quite clear they do think that there is more room to cut. Probably terminal rate could be around 3, slightly over 3%, 3.5% kind of range. The question, of course, is how fast they get there. So if we get a couple more months of stronger than expected labor markets, stronger than expected core inflation numbers, then, they may actually decide to slow down the pace a little bit going forward.
So let's move to China, because we have this Ministry of Finance announcement tomorrow on a Saturday morning. A little unusual, although it is a working day in China because of the way the holiday fell. Nonetheless, the markets won't be open, so people will have a chance to think before they act in markets. Bloomberg Economics is expecting a pull forward, a lot of the stimulus from next year, a lot of the fiscal spending from next year into this year. How do you see it?
Well, certainly high hopes for the MOF announcement tomorrow. So the speculated size of this policy stimulus is running into trillions of yuan. So, some people say 2, some people say 5 or more. So I think rather than just focus on the headline number per se, what is really critical is this going to be fresh stimulus? Is it just a front loading of the stimulus that was meant to come next year? And whether it's actually going to be targeted at supporting consumption, especially for the more vulnerable segments of the population, such as the old and the aged and the poor, rather than going into infrastructure investments, which had been the model of the past. So, I mean, remember, consumption has a lot more multiplier effects compared to just infrastructure. And I think in particular, if there's going to be additional fresh funding for local governments, then obviously that could kind of accelerate the ability of the latter to actually execute policy stimulus.
So if
But we have seen,
I'm sorry, Selena, if we can agree that the real problem is the lack of positive sentiment in China, is a higher equity market, does it go a long way to addressing that ill?
well, there are three components to, driving the animal spirits or consumer sentiments, right? So equity market is one, or property market is one. The other one, of course, is income expectations. So a lot of these policy measures that have been announced so far actually do help to stabilize the property market corrections. They have contributed to an equity market rally. So these are positive factors. But the last part, which is really the income expectations. So job, market, if it's still soft in China, then that would be the weakest leg in the whole equation.
It seems like the issue for the Ministry of Finance will be to try to sustain some of the positive sentiment from the market rally without getting it too far. They don't want irrational exuberance. Do you think they have the nuance and the skill to do so?
Well, that is certainly true because, I mean, if you look at how the Chinese equity market rally had petered out this week after coming back from the Golden Week holidays. So we are seeing this continued injection of policy stimulus. That generally should be supportive. But I think the policymakers would rather see a slow and gradual pace of rally in the Chinese equity market than a boom-bust type of scenario. So to me, expectations management is actually the key. They don't want to have market disappointment. I mean, if you see what happened after the NDRC announcement earlier this week, obviously it was a little bit underwhelming. Market was disappointed.
If you had to bet right now on the effectiveness of everything that we know in terms of the stimulus package that's been unveiled, do you think it's going to succeed very quickly?
I think it definitely has stoked some positive sentiments on the ground as far as the property market and the equity market is concerned. Equity market has run ahead, property market is a little bit slower.
All right, Selena, thanks very much. Selena Ling, Chief Economist at OCBC with us, also market strategist. Minmin, Bloomberg TV China correspondent, and someone that we can talk with about what we might get from the Ministry of Finance tomorrow morning. So there's a lot of expectation on this, Minmin, and I note from the China Today column, they think that investors may well wind up being disappointed. I don't need you to speculate on that so much, but what might we be getting tomorrow from the MOF?
Yeah, so market expectations are really high right now. Bloomberg had done a poll of 23 market participants, and the consensus now is that the government is going to roll out a 2 trillion yuan fiscal stimulus, although there are 4 participants expecting something above 3 trillion yuan. But our Bloomberg economics team believes that there is not going to be any fresh stimulus at all, so pretty divergent views out there. And I also have to remind you that the reason why China Today, that piece had said that expectations are overblown is because any sort of revision to the fiscal budget deficit to GDP ratio, as well as issuance of additional bonds on top of this year's quota, that will have to be approved by the legislature, which is why we think that perhaps a more appropriate time for new fiscal measures to be announced would be after the NPC Standing Committee meeting in end October.
So what do we know about how this is going to be focused or targeted?
Yeah, so we are looking for forward guidance from the ministry, even if we don't get that number. But of course, more important than the scale of the fiscal stimulus is the content of it. What is the funding going to be focused on? Is it going to be targeted at boosting consumption? That's what investors really want to see, as opposed to the usual, infrastructure investment or supply side policies that, is China's old playbook. So investors are looking out for consumption vouchers, perhaps an expansion of that existing equipment upgrading program, and perhaps direct cash handouts to certain sectors of the population like the elderly and the poor, support for families with children, for example. And if the bulk of that money is going to be helping to bolster local government financing, for instance, by swapping out local government hidden debt with bonds of lower interest rates. Nomura is saying that then that shouldn't even be considered an incremental fiscal stimulus at all.
We talked a little bit about how the Ministry of Finance will likely want to keep a little bit of momentum in terms of sentiment, but just not go too far. And actually, the way that Bloomberg Economics described it, pulling forward from next year some of this bond issuance and some of this deficit spending, it also suggested that they would later, into next year, like you said, which brings in the NPC, have scope for adding to it. So it's potentially an add, but it's down the road. Is that the kind of nuance that that investors can handle with the MOF, or is it more likely to be disappointment?
Yeah, there are a few factors at play here. So many analysts are expecting any sort of fiscal package to be a multi-year thing. And Bloomberg Economics is saying that because fiscal spending has been a drag this year, they haven't even finished spending the budget for this year. Only 55% has been spent. So the MOF briefing tomorrow might focus on disbursing the existing unspent allocations, which is still 18.4 trillion yuan. So quite a sizable amount there. And as you said, advance issuance of next year's quota of local government special bonds and special sovereign bonds, that could happen, which means it shifts forward the timeline. It means that fundraising and planning for related projects can start this year, but then spending will likely still take place next year because we're already in mid-October, not much time left. And also, there's also the aspect of the US elections. And so some economists that I've been speaking to say that China may want to reserve some fiscal firepower for a potential Trump administration. If there is 60% tariffs on Chinese goods, then they want to reserve some space for more fiscal policy next year.
I was reading a column from opinion columnist Mohammed El-Arian, and he credited a friend with a couple of points. One, China cannot fix its micro problems with macro tools. That's one. And second, that required micro tools will need time not only for formulation but impact. So the question is whether or not markets can be really patient in this environment, or whether there is the demand right now to see results and let's get to the next level. Do you think that's pretty accurate?
Yeah, I think so. I mean, if you look at market action yesterday, the CSI 300 was flipping between gains and losses. I feel that investors really don't know what to expect. And expectations are extremely high, especially after the Politburo meeting where the government signaled that they're going to put their whole weight behind the economy. That's just, drummed up expectations very much. And I think Clock Tower, that's one of the Clock Tower group. Their analyst is saying that they're expecting, even if the MOF press briefing disappoint investors tomorrow, and if there is a sell-off of 5-10% in the markets, they're going to view this as a prime buying opportunity. They're expecting that market peaks in May will now act as a solid floor for this current news cycle, because they said the entire backdrop, the policy backdrop and sentiment is really quite different now from what it was several months ago.
Just in 20 seconds or so, I just note that something has moved. China will address market concern in a timely manner. That's from the chief of the NDRC. So they're very much aware that the market was really disappointed with what they got. So at least they're showing the intention of addressing some of these concerns. 20 seconds.
Yeah, it looks like the government is really signaling to, local officials to listen to the voice of the market, because we also had Premier Li Qiang seeking opinions from academics and experts as well to listen to the voice of the market before formulating policies.
All right, Minmin, excellent stuff as usual. Thank you very much. Minmin Lo, Bloomberg TV China correspondent.
This has been the Bloomberg Daybreak Asia podcast, bringing you the stories making news and moving markets in the Asia Pacific. Visit the Bloomberg Podcast channel on YouTube to get more episodes of this and other shows from Bloomberg. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen, and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app.